everyone, this is Chris Thomas speaking to you from One Accounting Office in Edinburgh. Apologies for the slight delay in starting the webinar this morning with a few technical gremlins, all self-inflicted. So hopefully you can hear me loud and clear. So what we're going to be doing today is presenting a short webinar following last week's referendum to look at what a no vote actually means for small businesses in Scotland. Before we start, I'll just show you who we are. We've got plenty of clients on the call, but I thought it'd be useful just to have a quick photograph of our team here. So we actually had a mock referendum vote in the office last week, and we took a photo of our merry band of men and women. So I'm the chap third from the left, for those of you who haven't met me before, and that's the rest of the gang as well. Okay, well it's fair to say, in the words of Bob Dylan, that the times they are changing. So, a week is a long time in politics, and there's been plenty of announcements that have been released over the last week or so, since we had the referendum and the lead up to the referendum as well. What we're going to be doing today is actually looking at the impact of the no vote for SMEs, and there's some changes that we definitely know will be happening. And we're also going to be looking at some changes that might actually happen based on what the main political parties have actually said. So if we start off with the facts, as it were, a couple of key points just to set the scene in terms of the next elections. For the UK election, whole of the UK, that's actually in May 2015, and at the moment we have a Conservative and Lib Dem coalition with a fairly healthy 76-seat majority. And then a year later in Scotland, we have an election on the 5th of May 2016, and as you can see there, the SNP have overall control, but only with a very small two-seat majority. So that may actually influence the way that all of the main political parties are going to act over the next year or so. Okay, just go to the next slide. All right, so again, just to set the scene in terms of where we are actually now. So Scotland makes up 8% of the entire UK economy, and what we're experiencing here at One Accounting is that our clients are doing pretty well. So unemployment has actually fallen in Scotland. The figures were announced last week, so we actually have more people in employment in Scotland than ever before. So the 2.6 million people in work is actually a record there. And in terms of the main financial benefit that our clients, our SME clients, have felt since the Scottish Parliament was set up, is small business rates relief. So plenty of clients, and this may actually apply to you, can actually receive a discount of up to 100% on their business rates. And a little fact is that Holyrood has actually had the power to increase or decrease income tax by up to 3p in the pound. So that's existed since the Scottish Parliament was actually set up, but that's never been used. So it's quite an interesting fact in terms of the next few slides we're actually going to look at. Okay, so change number one. So this is definitely going to happen. The Scotland Act 2012 is going to receive royal assent in the next couple of weeks, I believe. What it actually is the largest financial power from Westminster up to Scotland. So a couple of things that we know are going to happen. First, in April next year, a couple of the minor taxes, the land taxes, are transferred under control of Holyrood. So their current names are stamp duty, land tax, and stamp duty, land tax, and also landfill tax as well. And they are going to be transferred, like I say, in April 2015. But perhaps the more interesting thing is going to happen the following year, in April 2016, when the Scottish rate of income tax is introduced. Let me just talk for a minute or two about the Scottish income tax rate. So, what will happen from the 1st of April 2016 is that the existing UK tax rates will all reduce by 10%, and then Scotland can then set its own Scottish tax rate to sit on top of the 10%. So say, for example, the politicians think it would be a good idea for us all to pay less income tax, and they would reduce the Scottish tax rate to 8p in the pound. Then I've put a table there at the bottom to show what the actual income tax rates will be. So the basic rate of tax at 20%, what will happen from April 2016? Well, the UK rate of 10%, add on the Scotland rate of 8%, giving a total income tax rate of 18%. And then you can see there how it would actually affect the higher rate tax bands of 40 and 45%. Of course, it can go the other way as well. So if whoever's in power, well, in April 2016 we'll be coming up to a Scottish election, but I think you'll see this in the manifesto of all three parties. They'll actually specify what they're going to be doing with tax rates. So some may choose to actually put the Scotland rate up if they want more money to spend on things like housing benefits and other services as well. Might not be a vote winner, but some people might actually want to increase the Scotland rate. So that's going to happen from April 2016, about 18 months' time. So I spent the weekend actually delving a little bit closer into this. So I was reading lots of documents online, and contained in the small print regarding Scottish tax rates is actually something which affects a lot of people. So it doesn't actually apply to dividends or indeed bank interest received. So the relevance of this is that for the majority of profitable, if you're running a profitable business and it's a limited company, then the most tax efficient way to pay yourself is a mixture of a small salary with a balance in dividends. And the reason that you do that is because there's no national insurance on dividends. So what has been announced effectively is that the Scottish tax rate wouldn't apply to dividends. So for those of you out there that are following that model, if, for example, the Scottish tax rate would take income tax below the UK rate, that would only apply to your salary effectively. What it would mean for the dividends is that you would continue to pay the UK rate, which potentially would lessen the incentive, if you like, of lower Scottish taxes, because you continue to pay the main UK rate. Interestingly as well for us as accountants is that what we're going to have from 2016 is something called a Scottish taxpayer. So we've seen this a little bit actually in Ireland, where obviously you have two separate countries there. You have the north and the south. And you have the concept of what's called a frontier worker. So this means that somebody living in the Republic of Ireland but working in the north of Ireland will pay their taxes in Northern Ireland, although they live in the south, but it means that they actually have to submit two tax returns to account for their income in both countries. So what, again, has been announced is that we'll have this concept of the Scottish taxpayer, but it's based on where you live rather than where you work. So if you live in Scotland and work in England, then you are a Scottish taxpayer and vice versa. And as yet, for those people that maybe work in a lot of time spent crossing the border, at the moment, again, the definition of the Scottish taxpayer is based entirely on residence rather than where you work. So what you could see, and again this is all speculation, but if the Scottish rate of tax is going to be different from the rest of the UK, then potentially this might mean people moving so that they can move to Scotland and enjoy lower tax rates, or if the Scottish tax rate is going to be higher, potentially it may mean some border workers are going to move the other side of the English border as well. So in terms of actually looking at things like residency tests, there's certainly going to be a few clients out there, maybe towards the south of the country, that this is actually going to affect. Okay, another big change as well is that there is actually a new body which has been set up, and it has 30 people working for it at the moment, called Revenue Scotland. So this is going to be a new tax authority for collecting the taxes that have been devolved up to Scotland. So the first two that it's going to be involved in collecting will be what's known as stamp duty land tax, which is going to be renamed as land and building transaction tax, and also landfill tax, which is going to be renamed as Scottish landfill tax. So that's the first job for Revenue Scotland, is to collect those two taxes. So the rates are set to be announced next month on those by John Swinney, who's the Finance Secretary. But again, interestingly, whatever happens with the Scottish income tax, that is going to be continually collected by HMRC as well. So you'll see there, and I'm sure this will form part of the discussions over the next weeks and months, is that you know, on first glance you think, okay, Scotland does have its own income tax, but it's actually still going to be collected by the main UK tax authority and HMRC. Okay, that ends the what will happen element of the webinar. Okay, what we're now moving on to is what might happen. So it's hard to believe, but this is actually the front page of last Tuesday's Daily Record. So less than a week ago we had this vow, which has been signed by David Cameron, Ed Miliband and also Nick Clegg, about the changes that they would deliver to Scotland if Scotland voted no. So obviously we know from Thursday's vote that that's the case, but I think the goalposts have started moving already on this one. So this is speculation, but this is what the three better together, if you like, parties have previously announced in additional tax powers that they are going to give to the Scottish Government. So there's disagreement on all of these from the beginning. So firstly, the Scottish Labour Party, with income tax, we know that the Scottish rate can vary up to 10p. They would increase that to 15p, but it would mean that Westminster would still regain control at the basic rate of tax of 5p of that. And Labour haven't proposed giving any power over the other taxes such as corporation tax, VAT, etc. over to Holyrood. Scottish Conservatives are actually going to do more. They will give full control over income tax, so it means that the Scottish Government would have full responsibility for setting the rates and collecting the tax and spending it as well. And also they proposed that a share of Scottish VAT receipts would be assigned to the Scottish Government, but no power over corporation tax or inheritance tax or indeed capital gains tax. And the Scottish Lib Dems have actually proposed to do the most, I think. Again, full control over income tax, and what they're proposing there is that they will give power of IHT and also capital gains tax over to the Scottish Government as well. So they're actually proposing to give the most powers, but again, it's important to point out that there the Lib Dems are unlikely to gain full electoral control of either the UK or the Scottish Parliament as well. I think what will actually happen is that the main parties, effectively the Westminster flavour of these parties, are really going to have to thrash out an agreement between them on what they perceive as to be the best offer, if you like. My own gut feeling it's going to be somewhere in the middle. I think when you've got opposing views like this, there's going to be compromise and some watering down of the powers that are going to be transferred. So what does the Scottish Government say? Well, there we've got a picture of the outgoing First Minister, Alex Salmond, and for most people who believe that Nicola Sturgeon is going to come in unopposed, I think, as the next First Minister of Scotland. So if you go back a few years, the Scotland Act that we just covered, the 2012 Scotland Act, was formed as part of something called the Calmer Commission. So the SNP didn't actually take part in that, but they have supported the recommendations. So again, just reading the press over the weekend, the new First Minister is likely to be involved more in the discussions on the increased devolution. So it could become a four-way discussion between the three main Westminster parties.
I'm from Greg, I'm from Gary, I'm on the phone on that.
Okay. All right, so just to finish off, on the next point here we go. Right. So again, depending on what powers are agreed by the Westminster Party, Scotland will be subject to fiscal risk. So what this means is that if the Scottish economy is granted extra tax powers and the economy does well, then Scotland will have more tax revenues. If the opposite is true, and actually does, the Scottish economy suffers a little bit, it means that Scotland effectively will have less tax money and will have to make its own spending cuts. So again, what has happened in terms of Mr. Cameron hinting at English votes for English policies, again, I think you might see what's going to happen in Scotland in terms of sharing the fiscal risk applied to maybe Wales and English regions as well. So this is the point that's actually up for discussion. But in theory, I think that sounds quite a good thing. So it would mean that the collection of taxes, majority of taxes transfers to Revenue Scotland, and then Scotland has more say over how it actually spends money. We'll just go on to the next slides. In terms of some other trends that we've picked out which might happen, again, following the no vote, and specifically how these are going to affect small businesses in Scotland. So the first point is on the property market. So anecdotally, we've known from our clients that there's been a bit of pent-up demand, people hanging off on either moving houses or taking on new offices, if you like, commercial properties. So a lot of people just waiting to see what's going to happen with the vote. And for those that have more confidence, if you like, in what's going to happen with the UK, then I think what you'll see there is more activity in certainly the residential housing market and also commercial property as well. So again, I think what you'll see there is maybe some short-term price rises. Another thing as well, on Friday the pound reached a record high, and indeed the stock market will most are ahead, I think. It's nearly at an all-time high at the moment. And I think given the extra confidence perhaps that the no vote has given in terms of stability, the stock market is going to strengthen as well. The forecasts for the UK growth rate are very good. So the 3% this year, unfortunately, I think what that's going to actually lead to is an interest rate rise in March next year. So certainly businesses with fixed term loans, fixed rate loans are going to be okay. Those of you with variable loans and perhaps low overdrafts are going to see some sort of increase next year as well on that. And in terms of, again, reading the press over the weekend, there's probably less chance now of Britain exiting the EU. Again, if you believe the opinion polls, more Scots are in favour of staying in the EU than perhaps the people south of the border. Obviously, we've got the rise of UKIP as a political party south of the border who are advocating exit from the EU. So, again, the no vote has probably strengthened the British view on staying in the EU. Again, we've seen there that there's the vow which has been issued last Tuesday. We're not really quite sure what that means. So it's possible that some people and some businesses will actually wait until that's been announced. So in terms of the timeline of that, what they're proposing is that that receives royal assent by May of next year. We've obviously got an election in the UK in May of next year as well. So I think the parties are going to have to get their viewpoint on this established fairly quickly. So it's possible that those businesses may be looking at expanding, they're just going to hold back to see what will happen next in terms of the VAW package. But like I say, in terms of my own thoughts on small businesses, Edinburgh certainly, there's a lot of growth that we're seeing amongst our own clients. I think the no vote, whatever your political persuasions, at least now we've got some sort of certainty for the next couple of years about the general economy. And it's fair to point out there that the tax changes that are coming in 2016 were first discussed probably 6-7 years ago and actually committed to law 2 years ago. So I think whatever changes are going to happen as part of the VAW package, if you like, I wouldn't expect them all to be in place on the 1st of May next year. I think there'll be proposals which will then be introduced over a period of time. So again, the main tax changes seem to be proposed on income tax. None of the political parties have suggested that a cut in corporation tax is on the cards. I think initially we're going to see the devolvement of income tax raising powers, which obviously affects small business owners, it affects their staff as well. But in terms of the other taxes such as VAT and corporation tax, we're not expecting to see any change in those north or south of the border, just purely because of the complication of running 2 different tax rates for these taxes in the UK. Okay, well that concludes on today's webinars. I hope you found that useful. So what we generally do with all our webinars here is that we publish them to YouTube. It'll probably be going up later on today, so that you'll have access to all of the slides from today's webinar today. And indeed, if there's anything you'd like to discuss with anyone here, so either myself, Chris, or Neil, my co-director here, in terms of how these potential changes are going to impact on your business, then by all means, please do give us a call. Get in touch. Okay, we'll leave it there. Thanks very much for attending and have a good day. Bye-bye.